Okay, let's dive right into this explainer. Today, we're doing something a little bit different and honestly, a lot of fun. We're going to run a single stock through the ultimate valuation stress test, what we call the Guru Gauntlet. Basically, we're going to synthesize some recent earnings reports and analyst estimates, and then look at one specific company through the eyes of history's absolute greatest investors. The stock we're putting in the hot seat? LGI Homes, ticker symbol LGIH. Now, as of our recent market data, it's trading at exactly $58.48. But here's the million-dollar question we have to answer today. Is that price a dangerous value trap just waiting to catch unsuspecting investors? Or is it a screaming buy that the broader market has completely mispriced? Here's our roadmap for the gauntlet. We'll start with a quick snapshot, run the stock through the Buffett, Lynch, and Graham lenses, follow that up with some uncompromising DCF and comparable modeling, and then give you our final verdict. All right, Section 1, LGI Homes, the contender. So LGI Homes is this really fascinating player in the real estate space. Headquartered right in Texas, they're a pioneer in home building with a super disciplined focus. Basically, they build 100% spec homes specifically targeting the entry-level market. For us as investors, understanding this build-it-before-you-sell-it model is absolutely crucial for figuring out their margins. It's a strategy that's let them close over 80,000 homes across 36 markets since they started back in 2003. And get this, they've delivered profitable financial results every single year. Let's look at their baseline numbers here. We've got a market cap of about $1.36 billion, trailing 12-month earnings per share at $3.05, and a PE ratio sitting around 19. But I want you to notice the massive disconnect at the bottom. Check out their $58.48 trading price compared to their $90.50 book value per share. The company literally has over $2.1 billion in equity sitting on its balance sheet. You are essentially buying their underlying assets for roughly 64 cents on the dollar. But is that enough of a safety net? Let's move to Section 2 and find out using the Warren Buffett lens. You know, Buffett looks for a few absolute non-negotiables, and surprisingly, LGI passes almost all of them. Economic moat? Pass. They have a low-cost, self-developed land pipeline that's practically 100% on their balance sheet. Management? Pass. They even made Newsweek's list of the world's most trustworthy companies. Consistent earnings? Pass again. Manageable debt? Yep, 44% net debt to capital. But they hit a brick wall on return on equity. Due to a really tough first quarter where net income came in at just $2.16 million against that massive $2.1 billion in equity, their immediate ROE is just too low. That is a major red flag for Buffett, who, as we know, loves highly efficient capital compounders. And man, when we apply his uncompromising valuation math, it gets even tougher. If we calculate conservative owner earnings based on that trailing EPS of $3.05, assume zero growth, and use a standard 10% discount rate, we land in an intrinsic value of $30.50. Now, Buffett notoriously demands a strict 50% margin of safety. That means he wouldn't even think about buying unless the price dropped all the way to around $15.25. So looking through the strict Buffett lens, LGI Homes is a hard pass right now. So Buffett might walk away because of the low immediate ROE and lack of a massive safety net on trailing earnings. But what would Peter Lynch think? He views the market totally differently. He loves a good cyclical stock, especially if the future growth aligns with the current price. Lynch relies heavily on the PEG ratio. It's his ultimate shorthand to figure out if you're paying way too much for future growth. Simply put, it's the PE ratio divided by the growth rate. A PEG under 1.0, that's where he starts hunting for bargains. And this right here brilliantly illustrates why a growth investor might be salivating. Sure, their trailing PE is 19.17, but we need to look forward. The analyst consensus for full year 2026 earnings is $4.68 per share. Compared to the trailing $3.05, that implies a massive 53% growth rate. When you crunch those numbers, you get an implied PEG ratio of, wait for it, an incredible 0.36. For Peter Lynch, finding anything under 0.5 is rare and honestly pretty spectacular. So this is a very strong Lynch buy signal. All right, moving on to Section 3, the Benjamin Graham lens. Graham is the absolute godfather of deep value investing. He wants adequate size, which, check, a $1.36 billion market cap gives us. He demands strong finances. LGI has $4 billion in assets, completely dwarfing $1.9 billion in liabilities. Pass. Earning stability? Pass. They've been profitable since 2003. Now, they do fail his dividend requirement since they don't pay one, but look at that bottom row. A moderate price-to-book ratio is essential for Graham. An LGI's ratio of 0.64 is screaming value. You are buying hard physical real estate inventory at a steep discount to what's actually on the books.
We can actually put a solid number on this. Using Graham's famous intrinsic value formula, where you take the square root of 22.5 times the earnings per share times the book value per share, we landed a fair value of $78.80. With the stock currently trading in the $58 range, Graham's formula is giving us a massive 25% margin of safety today. For a deep value investor wanting some serious downside protection, that's incredibly compelling.
Okay, Section 4, the quantitative trials. Let's look at the DCF and alternative models. We've consulted the investing legends, so now let's just strip away the philosophies and look at the raw, unemotional math. To build our discounted cash flow model, we've got to make some logical assumptions. We know housing is highly cyclical, right? So instead of that aggressive 53% analyst bump we talked about, let's model a much more conservative 5% cyclical growth rate for cash flows. We'll assume a standard 2% perpetual growth rate for the terminal value, basically just tracking long-term inflation. And finally, because of that 44% net debt to capital ratio, we'll apply a 10% weighted average cost of capital to discount those future dollars back to today. Now, the real crucial point is right in the middle of this sensitivity table. Even under our super baseline assumptions, a 10% WACC and a modest 2% terminal growth, the DCF model spits out a fair value of $72.50 per share. You'd have to aggressively hike the discount rate up to 12% and drop terminal growth to 1% just to make the current $58 price look fairly valued. The math is strongly suggesting that the downside risk is heavily priced in already. Let's check one more model, basic comparable multiples. If we assign LGI a standard homebuilder industry PE multiple of 15 times against their trailing earnings, we get a fair value of $45.75. So, yeah, they look a bit overvalued on trailing earnings. But, and this is a big but, if they ever revert to an industry standard 1.0 price-to-book multiple, which is totally normal for a healthy builder, that fair value rockets straight up to $90.50. The book value is the massive anchor here pulling that valuation upward. Which brings us to Section 5, Synthesis, and our final verdict. Looking at our final scorecard, it's remarkably one-sided. Warren Buffett's ultra-strict focus on trailing owner earnings and immediate ROE results in a pass. But the other four frameworks, they are practically screaming buy. Peter Lynch's forward-looking PEG ratio is phenomenal. Benjamin Graham's deep value formula loves the asset base, and both our baseline DCF model and the price-to-book comparables show LGI Homes sitting well below its intrinsic value. But hold on, before you go rushing to your brokerage account, we absolutely have to understand the why behind this price. The market isn't blind, right? The key risk here is the macro environment. In Q1, their cancellation rate spiked to a genuinely scary 45.6%. That tells us point blank that home affordability is still a huge hurdle for their entry-level buyers, which drags down that current return on equity. On the flip side, though, management just raised their full-year adjusted gross margin guidance to between 22 and 24%. Plus, their backlog, sitting at 1,699 homes under contract, is actually up over 63% year over year. So they are actively navigating the storm. So, what's our final verdict for this explainer? We rate LGI Homes as a value buy. Yes, for sure, the housing market is cyclical and super dependent on interest rates. But that massive 35% discount to their actual underlying land and book equity, that provides a really rare margin of safety. If management can hit those forward estimates, the current price is an absolute bargain. We've run the numbers, we've survived the guru gauntlet, and we've laid out both the clear bull and bear cases for you. But at the end of the day, investing is deeply personal. Knowing the risks of the housing cycle, but seeing that incredible discount to book value just sitting on the table right now, at what price does LGIH enter your portfolio? Take that question with you as you continue your own research. Thanks so much for joining me for this explainer, and keep learning.